cannot believe how much just terrible information there is out there floating around on the internet about Roth conversions. It's pathetic. I'm Stephen Neely, certified financial planner and founder of Fortress Capital Advisors, where I focus on helping retirees. In today's topic, we're going to talk about Roth conversions. I wanted to do this video after I read a MarketWatch article where a reader had emailed in asking about some advice he had gotten recently about a Roth conversion. And to be honest, that advice was really just terrible. And unfortunately, I think there's a lot of misleading advice on Roth conversions out there. So I wanted to take some time and kind of dispel some of those myths. But I also wanted to actually, talk about Roth conversions in general and when you would want to use them, because quite frankly, they are a very powerful tool if done correctly. So today, what we're going to cover, we're going to talk about what is a Roth conversion, why do people do them. We're going to jump into a topic, what I call breaking out of pensioners' prison. And you can break out of pensioners' prison by doing Roth conversions. And there's a couple of different methods. One I call the Kool-Aid Man method. And the second one I call the Shawshank Redemption method. Then we're going to take a look at some real life examples using my financial planning software. And so we're going to kind of go, when would the Kool-Aid Man be more appropriate, or when would the Shawshank Redemption method be more appropriate? And then finally, we'll kind of wrap things up with a summary. So let's get started. All right. Now, before we even get into what a Roth conversion is, it's important to go over the two main types of retirement accounts that are involved in Roth conversions. There are a lot of retirement accounts out there, but you can really break it down into two simple buckets. And so the first bucket is what you would call tax deferred or pre-tax accounts. And these are the things that people are most familiar with. Think company retirement plans like 401ks or a 403b, 457, or think of a traditional IRA account. And so most people that are saving for retirement have these two types of accounts. In a lot of situations, the bulk of their retirement savings is here as opposed to anywhere else. Now, what's very important to know about a pre-tax account is that you don't pay income taxes on the money you contribute on the way into these accounts. So let's give a simple example. Let's say your income for a year is $100,000 and you put $10,000 into your 401k that you have at work. What that means is that at the end of the year, that's going to reduce your taxable income from 100,000 down to 90. So you're not going to have to pay federal or state taxes on that $10,000 that you put in. Not only do you get the tax benefit, which is cool, but the funds grow tax-free. So in a normal situation, if you saved money in a taxable brokerage account, you put that $10,000 in there, you're going to pay taxes on dividends, you're going to pay taxes on interest income, and you're going to pay taxes on capital gains as these funds grow over time. Now go back to the pre-tax, let's say your 401k account, you put $10,000 in, and it's just going to keep growing over time, and you're not going to have to pay taxes on interest or earnings or capital gains over that time. Not until you start to take the money out at retirement, which is our next bullet point here. When you retire and you start withdrawing, now all of a sudden everything you take out of this account, both your contributions and your earnings, are going to be fully taxed at your income tax rates. And so that's where they kind of get you. Uncle Sam is always going to get his. Another thing to know is that you are going to be forced to take what are called required minimum distributions. So right now, anybody age 72 and a half will be forced to start taking required minimum distributions. We call them RMDs. You will be forced to start taking those every year once you reach 72 and a half. If you don't turn 72 and a half until 2033, you don't have to start until you're 75, actually. So that'll be good. So if you're a little younger, you got a couple more years before you have to start taking these. Another thing to note is that non-spouse inheritors, right, your beneficiaries, if it's not your spouse and they inherit this account, they're going to be forced to liquidate this account within 10 years, which is different than it used to be prior to the Trump tax cuts. And so you need to be aware of this. If your children are high earners and you have, let's say, $1 million, $2 million bucks in an IRA that they are going to inherit, they're going to be sitting on a massive tax burden as they draw this account down over 10 years. The other type of account is what you would call tax-free or after-tax, and these are Roth accounts. Not as common as a regular 401k, but there are Roth 401ks. So one bit of advice I would give to you is that if you have access to a Roth 401k, talk to your CPA or financial advisor and see if you wouldn't be better served contributing to the Roth rather than a traditional, because it can make a big difference. Now, what's the distinction between this and a traditional IRA? Well, it's that you've already paid taxes on this money that's contributed. So go back to our example of I put $10,000 in. That's not going to reduce your taxable income at the end of the year. Now we'll start to get into the benefits. For a Roth, the first benefit is that the funds grow tax-free. Now that's quite honestly just like they would in a regular IRA. The real benefit here is that when you start to withdraw after retirement, withdrawals are not going to be taxed. That's awesome. So let's say you put $10,000 in, grows to 20 grand. You take the $20,000 out, none of it is taxed, the contributions nor the earning. The point to emphasize, there are no required minimum distributions with this. So the government's not going to force you to start taking RMDs at 72.5. And the last point, and this is very interesting, is that non-spouse inheritors will be forced to liquidate in 10 years, just like they will with a regular IRA. But they're not going to pay income taxes on the withdrawals. So as an inheritance tool, this could be very, very powerful. And you don't hear about this as often as you do, the people doing Roth conversions just to save money on taxes in their lifetime. But another really good reason to use it is to save taxes for your heirs over their lifetimes. Because what they can now do, you draw this account down and then they just put it in their brokerage accounts and let that grow. But that saves them a ton of money over time rather than taking it from the IRA where they might pay up to 50% in taxes. They're just left with a much smaller pot to grow for themselves. So what is a Roth conversion? So it's when you take money from a pre-tax account like a traditional IRA and you roll it into a Roth account. You have to pay taxes on the amount that you roll over. So let's say you took $100,000 and did a rollover this year or a conversion, right? You would have to pay taxes on that full $100,000. So if you're going to pay taxes, why do this? Well, usually it's to save money on taxes later in retirement. We talked about the dreaded required minimum distribution. And so if you want to reduce those, this could be a great method. But you have to think about the totality of the situation here. Not just, I want to save taxes later, because you might be shooting yourself in the foot by paying more taxes now than you would have ever paid later. And so that's the kind of stuff we're going to talk about today. When does this make more or less sense? If you believe you're going to be in a higher tax bracket in retirement, this could make a lot of sense. At a minimum, they're probably going to let the Trump tax cuts sunset in 2026. So, your tax rates could actually go up. The second reason people do Roth conversions, we already kind of touched on this, they want to reduce the overall taxes paid due to RMDs. So at 72.5, Uncle Sam is going to come to get his. A lot of people don't want to pay that much in taxes because they were never going to withdraw that much at that time anyway. And so doing Roth conversions can help reduce the burden of taxes paid on RMD. Another reason to do one is if you had a down year in income. Maybe your business had a loss, or maybe you switched jobs, got fired, whatever. Now might be a time to consider doing a Roth conversion. Another way is a more efficient transfer of assets to your heirs. This was the one I talked about. It's a much better method of transferring assets than an IRA if you put them in a Roth IRA and give them to your beneficiaries, especially your children or grandchildren. Last one is if you make large charitable contributions, you can also simultaneously do Roth conversions because if you're reducing your tax burden here, you can bring it up to the same level, but ultimately you'll be growing your wealth more. And even if you're charitably inclined, this still means you're going to be able to, give more money to charity over time because you paid less taxes on it to begin with. So could make a lot of sense. Now we kind of know when the Roth conversion makes most sense. And let's kind of jump into the main part of our video. I like to tell people that, this idea you call pensioners prison. And what I mean by that is that most people in the US have kind of socked away the majority of their savings in these tax deferred pre-tax accounts. And it means a lot of them have pretty significant money, like 500,000 to a couple $1,000,000 or so in these accounts, the bulk of their savings, in fact, and now they're sitting on a massive tax liability. And everybody kind of, once they realize that, sort of starts to freak out because they're like, well, how do I get out of this tax liability? And one way to do that is by doing these Roth conversions. There's a couple of strategies that we are going to look at. The first one is what I call the Kool-Aid Man method. This is when you would do a large conversion at one time. I don't know if you're familiar with the Kool-Aid Man, but he busts through the walls in all the commercials, and there's no subtlety with his method at all. Let's just say that. This could be beneficial in some certain situations, and we'll get into when you would want to do that, but almost certainly you're not going to want to do the Kool-Aid Man method. The second one is what I call the Shawshank Redemption method, and this is where you would do consistent conversions over a number of years. So think about Andy in the Shawshank Redemption, where he sort of methodically, consistently digs himself out of prison over many, many years. It was probably like a couple decades or something. We could think of Roth conversions the same way, where we strategically do a Roth conversion every year over a certain number of years. And I'm going to tell you right now, the vast majority of people are going to be better off using this method of getting out of pensioners prison as opposed to the Kool-Aid Man method, though not always. Let me pivot over here. I want to talk about what prompted this video. So here's this Market Watch article that I saw. Somebody emails in. It says, hey, I'm 64. I was forced into retirement. Should I convert my $1.3 million to a Roth IRA? So what we'll focus on is the second question. Does it make financial sense to do a massive rollover of the IRA to a Roth IRA? Pay the taxes now when my income is low. I had a guy run the numbers, and it is mostly a wash. Look, guys, I can almost guarantee you it's not a wash. And this is where I said at the beginning of the video, there's so much bad advice floating around out there. In fact, I have a current client who came to me, and before he was with me, he had another financial advisor suggest that he do like $1 million Roth IRA conversion. And I ran the math. It makes no sense. He would be almost certainly worse off doing that. And you just get this bad advice out there. And so I'm going to show you what you need to think about before doing something that's pretty extreme. I'm glad that the reader emailed in and asked this question before just doing it, because there's almost no way that it's going to be a wash. So let's jump over to my financial planning software here, and I'm going to show you a real life situation. In this situation, the person is in a very similar boat. Got, a couple $1,000,000 in an IRA, the bulk of his savings. He really only has like a couple $100,000 outside of this in a regular, cash account, and mid-60s, getting ready to retire. And so the question for us too is, hey, should we be doing these Roth conversions, and what kind should we be doing? Now, in this chart, this assumes no Roth conversions. And this is the tax burden every year. And so I want you guys to kind of pay attention to what's going on here. Here he's still working. Here he works half a year. So that's why it just drops in the second year. Then you get these lean years of paying taxes, and then it kind of jumps up all of a sudden. So what's going on? You're working, you're paying higher taxes, then you retire, and that's where it just drops down really low. Once you get out here, age 73, That's when he's doing his RMDs. And so all of a sudden he had to take a lot more from his IRA than he would have normally taken. And so his tax burden has increased. So the question is, would he be better off doing the Kool-Aid Man massive one-time Roth conversion? Or would he be better off doing the Shawshank redemption where there's sort of a consistent amount over a certain number of years? Or maybe he wouldn't be better off doing either one of those. And that's the question that you have to ask yourself before you just jump in and do something like this just to avoid paying taxes. So this chart assumes no Roth conversions at all. And now we're going to compare the two different scenarios. So the first one, here's Kool-Aid Man method. Again, this is the taxes. The chart is very skewed by the dramatic increase in taxes, so it's kind of hard to even see. The blue is the regular income taxes, assuming no Roth conversions. The gray is the reduction in taxes, and the red is the increase. So pretty interesting chart. So I assumed he does a $1.3 million Roth conversion, just like the person in the Market Watch article. And that's why you get this massive red bar where he pays, a little bit more than $1 million in taxes that year, which seems incredible because he only took $1.3 million. And I'll explain what's going on here in a minute. Now, you do look at the other years, and the gray bars, he is reducing his tax over time because he wiped out his IRA, and he's not going to have to make those RMD. The net effect, however, is what we really care about, and this is where I call your attention to the middle box here, cumulative taxes. So what they're showing is he's going to end up paying $1.6 million of cumulative taxes over time, which in fact is $10,000 more than if he had done no Roth conversion. So in this case, he's worse off than he would have been. To the right of this, we'll look at the total portfolio assets left, and it's $2.3 million. But he's clearly worse off. Look, he's reduced the value of portfolio assets left by $470,000. Why is that? Well, he wiped out so much of his wealth and paying taxes up front that would have been growing over time that he's actually in a worse off spot than he would have been. Because, the $10,000 extra in taxes, that's not that, you can overcome that, but that doesn't add up to being $470,000 worse off. And like I said, it's because you took so much out up front that never had a chance to grow. What's happened here is this gentleman lives in a high tax state with local taxes that are also kind of high. And the second thing is he didn't have enough cash outside of his IRA to pay for the taxes, which is the same situation that the Market Watch guy would have been in as far as I can tell. So what happens when you do that? Well, that means you have to take more from your IRA to pay the taxes, which is just a double whammy and completely stupid. So he ended up paying way more in taxes. Then he had to pay the Medicare surcharge. He had to pay net investment income tax. If you do this, you're also going to increase the chances that you had Medicare premiums over time. There's something called IRMA. And so when your income jumps like that, you could pay thousands of dollars in extra Medicare premiums over the years because of that. And that also factored into why he has less portfolio assets left because, he had to pay higher premiums for expenses that he wouldn't have otherwise had. When does Kool-Aid Man make the most sense? Two situations here. One is if you have large net operating losses from a business, you probably do want to look at doing a huge Roth conversion all at once. So I remember back during the financial crisis, we had a few clients who, for a couple years in a row, they lost hundreds of thousands of dollars. That situation stinks, but we were able to make the best of it by doing like $500,000 of a Roth conversion at one time. You make the best of a bad situation, and that's a situation that you need to be on top of with your CPA and advisor. And it goes back to what I mentioned earlier. If you have reduced income for a year, you also want to look at doing a conversion, but even if you lost your job, you might not want to do $1 million Roth conversion. But if you lost $1 million, that's when it can make a ton of sense. Second, if you're doing these large charitable contributions, if you're giving away $500,000 to charity in a year and you've got that much in your IRA, you can just make it a wash by doing a huge conversion. Okay, so now let's look at the Shawshank Redemption method using the same situation. So here, rather than doing a huge, $1 million plus conversion up front, spread this out over several years. I think I had to do like $35,000 a year for several years until you kind of start taking RMD. And so what we're going to look at here is what happens. So similar situation, you paid all these taxes up front. The red indicates higher taxes, but not $1 million higher like we had before. And then you see the gray bars out there, and that was a reduction in taxes. That weird one-off blue bar, that's where I think I had him buying a car. And so he had to take it out of the IRA. And so he was going to be in a higher tax bracket anyway. And so nothing you can do about that. But once again, what do we care about? Our cumulative total taxes, and more importantly, the total value of assets left at the end. Now here's something interesting. Doing the Shawshank Redemption method actually decreased taxes paid over time by $22,000. Pretty good. Also, the portfolio value was increased by $290,000, right? And a lot of that is because you reduce the value of the taxes that you're going to have to pay over the years, and they got to grow longer and so on. So this ends up being a really good deal for our client. So when does the Shawshank method make the most sense? Well, it's when your situation is fairly stable and it's expected to remain so over. If you don't have drastic changes in income all the time and so on, almost everybody is going to be better off using the Shawshank Redemption method. And I'll tell you, the top place to do it is right after you retire, prior to you taking RMDs every year before that. You run the math, you look at the situation, and likely you're going to do Roth conversions then before you're forced to start taking RMDs. But you could do it longer, and sometimes if you retire and you're not taking Social Security yet, you want to do it then. But the vast majority of people are going to be better off with the Shawshank method as opposed to the Kool-Aid Man method. Now, you may be surprised to know, but the outcomes of both of those could have been drastically different had the circumstances been different. I looked at another client the other day. He lives out in California. He actually would not be better off doing any Roth conversions, which may surprise some people as much as they're pushed out there in the financial media as being, the one thing you have to do. But everybody's situation is going to be different. And so you need to be aware that these variables that I've got here on this slide are going to make a big impact on the outcome of the analysis. Investment returns, right? Higher versus lower expected investment returns are going to impact the outcome. Tax rates and domicile. If you look back at the Kool-Aid Man conversion with the example that we showed, if that person moved to Florida instead of staying in a high tax state and then did this massive Roth conversion, you would have a different outcome. Tax rates and domicile make a difference. Lifespan makes a difference. There is a break-even point with doing a massive Roth conversion, and so you would actually be better off over time if you live to, say, 100, for example. But there's so much uncertainty going on there. You're taking a big gamble if it doesn't work out. And last, the amount of money held outside of retirement account. If in our Kool-Aid Man example, he had all the money in a regular cash account to pay the taxes, instead of having to take extra money out of his IRA to pay the taxes, that would have changed the outcome as well. And so if I wrap things up here for you, what I can't emphasize enough is you need to be running this analysis every single year based on your specific situation, and don't think that there's some one-size-fits-all solution. Number two, I would highly encourage you to get a professional opinion on this, whether it's a CPA or a financial advisor. You don't have to have even a full-time financial advisor. You could just pay somebody hourly. But let me tell you, there are literally hundreds of inputs that come into this analysis, because you're not just thinking about, one-time taxes. You're thinking about my overall financial plan, am I going to be better off? And there are literally hundreds of assumptions that go into that. And if you're not kind of adept at what goes into that, you can make a big mistake if you miss some of these assumptions. And so I, I just can't encourage you enough to seek some outside help before you make one of these decisions. So that's it. I hope you got something out of the video. Thanks for your time.